Welcome back. You're watching Chartbusters here on CNBC TV18, and let's continue with our continued coverage of the primary market frenzy. Azad Engineering 740 crore rupee IPO opens for subscription today and will close on the 22nd of December. We have Mr. Vishnu Malpani, who is the whole-time director of the company, who is joining us now to discuss the company and the IPO in greater detail. Mr. Malpani, good morning. Thank you so much for joining in. I'll start off by asking you, please tell us what is the primary revenue source for the company, what is the main expenditure, and if you can tell us what are your key clients as well.
Sure. Thank you for having me on the show. I'd like to say that, Azad Engineering is in the business of making highly engineered critical parts for, very, very advanced sectors such as aerospace and defense, energy, and oil and gas. So we make mission critical and life critical parts that are, that are extremely critical for the applications of these industries. And we work with customers such as GE, Mitsubishi, and Siemens on the energy side of it, where we help them manufacture gas turbines, steam turbine parts, nuclear turbine parts, and hydrogen-based turbine parts. And on the aerospace side, we work with roughly around top 6 manufacturers in the sector, making engine parts and other critical parts for them. And in the oil and gas sector, we work with one of the top 3 clients in the sector. So we make parts that are eventually used to produce power or give thrust to the engines, or help our manufacturers in oil and drilling. Our business is roughly about 80% export. We export to about 15 countries around the world, and we operate out of 20,000 square meters of manufacturing space in Hyderabad. We have 2 manufacturing plants that are coming up in these high growth sectors, looking at the growth that we see in the business. So manufacturing is the primary source of revenue for us. And we delivered 251 crores last year as a top line with an EBITDA of 79.5 crores, roughly 80 crores. This year, H1, we've already delivered about 158 odd crores with an EBITDA margin of 33.3% at about 52.9 crores already, with a PAT margin of roughly 18.4%.
I take your point, Mr. Malpani, majority of your business comes in from manufacturing. Just a 2-part question. One is that while you have stellar repertoire in terms of your clients, could you tell us why is it that your operating cash flows have been negative despite strong, EBITDA growth over the last couple of years? And last year you did, revenues of 251 crores. I look at your receivables right now, they are 133 odd crores itself. Why is it that it's taking so much time to realize your sales into cash?
Sure. So we are in an industry. So I think what's important to understand is this industry has a lot of entry barriers, right? So for a supplier to sort of become, working with an OEM, it takes a longer duration for them to get qualified. So the entire process of onboarding a customer to start to, sort of get to manufacturing parts for them takes about 3 to 4 years. So you onboard a customer and then you start qualifying parts for them. And the process of qualification is really lengthy and stringent because we are making extremely critical parts, right? And that's why it takes time. Now, as a company that's growing at about 30%, if you look at our revenue CAGR, and the reason for operating cash flows being negative in the last 3 years would be, if you look at our revenue CAGR, it's been about 43% from 122 crores to about 251 odd crores. And if you look at our bottom line as well. So we're growing at that rate, and that's why you see the operating cash flow in high growth companies. That's the reason. The receivable cycle. So today, like I was telling you, we operate out of 3 verticals: energy, aerospace and defense, and oil and gas. So our cash to cash conversion cycle or working capital cycle is very normalized for a vertical we've been in business for 15 years. For aerospace and defense, these are verticals that we've gotten into in the last about 3 to 4 years, and that's why you see longer working capital cycle for them because of the process of qualification. So that's primarily the reason for it. And this is the nature of how companies operate in the sector that have and once you reach, it's one of those phases in the company where you start growing, and then there's maturity and decline. So we are in the growth phase, and that's why you see all of these factors coming together.
Right. You had mentioned that you intend to use part of your proceeds to retire some debt. Could you share what are the current debt levels, and how by when do you expect to become debt free?
Sure. So as of last financial year, we had working capital and term loan of about 142 odd crores, with cash in bank of about 46 crores. So the net debt in the company for us was about 96, 97, in that range, 96, 97 odd crores, and our EBITDA was about 80 odd crores for last year. So we plan to keep the company at the same debt to EBITDA sort of number.
Got it.
And in terms of the proceeds that we have from the IPO, 240 crores, we'll be deploying towards paying off debt. And the balance will be, about 138 crores will be deployed in paying off debt, 60 odd crores towards capex, and the balance will be put in general corporate expenses. So our deployment capital is only going to happen towards growth capital, which is either to create infrastructure or to create capacity, because that's the only constraint that we see in our business right now.
All right, final question then before we let you go. 60 crores is going into plant and equipment. How much will that yield in terms of incremental revenue? And what is usually the asset turn on a business like yours?
So as a business right now, we have an asset turn of about 1.3, 1.4, but that is because we're doing about 90% in the energy sector right now. Aerospace and oil and gas, typically these sectors are, have an asset turn of 2 to 2.5. So blended asset turn between energy, aerospace, oil and gas would be about 1.7, 1.8, and that is what you'll be able to see in the sector. Yeah.
All right. Mr. Malpani, thank you so much for joining in, and we wish you good luck for the issue as well as your subsequent listing as well. That was the management of Azad Engineering. Let's slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. We'll be right back.
CNBC-TV18, embarking on a quarter